Something has quietly shifted in the financial landscape. Not loudly, not with flashing headlines or breaking news banners, but if you know where to look, and if you understand what certain signals have historically meant, then you already sense that we are standing at a genuinely important crossroads. Welcome back to the channel. If you are here for the first time, I want you to know something. This is not a channel that trades in fear or sensationalism. We do not chase headlines. We do not predict the future with false confidence. What we do, and what we have always done, is sit down together, reason carefully through the evidence, and try to understand what the macroeconomic environment is actually telling us. Today's topic is silver. And before you dismiss that as a niche conversation for gold enthusiasts or survivalists, I want you to stay with me for just a few minutes. Because what we are going to discuss today is not simply about a metal, it is about a $47 trillion structural reality in the global financial system. A reality that appears to be quietly reshaping how institutional money is thinking about assets like silver. A reality that touches every portfolio, every currency, and every saver on Earth. So whether you currently hold silver, whether you are considering it, or whether you simply want to understand what is happening in global finance right now, this video is for you. Let us begin at the beginning. For most of the past 2 decades, silver lived in the shadow of other assets. Equities dominated portfolios. Technology stocks captured the imagination of a generation of investors. Real estate became the go-to store of value for the middle class. And gold, while respected, was often treated as a relic, something your grandfather held because he did not trust the banking system. Silver fared even worse in the perception department. It was seen as volatile, unpredictable, and difficult to value. It did not pay a dividend. It did not compound. It just sat there. And for most investors in a world flooded with liquidity and rising asset prices, that was simply not good enough. But here is what has changed. The conditions that made holding monetary metal seem unnecessary have been quietly unraveling. The decade-long era of near-zero interest rates is over. The assumption that governments could borrow endlessly without consequence has been tested and is now being tested more severely. The post-pandemic wave of money creation has left a lasting imprint on purchasing power. And the global debt load, which we will return to in detail, has reached a scale that would have seemed impossible to earlier generations of economists. We are not in the same financial environment that existed 5 years ago. We are not even in the same environment that existed 2 years ago. The structural backdrop has changed. And when the structural backdrop changes, thoughtful investors pay attention to assets that have historically served as anchors in turbulent financial seas. Silver is one of those assets, but silver is also something more. Unlike gold, silver is deeply embedded in industrial reality. It is not merely a store of value. It is a material of the modern economy, essential to solar panels, electric vehicles, semiconductors, medical devices, and the electronics that power daily life. That dual identity, monetary asset and industrial commodity, is precisely what makes this moment so interesting and so worth examining carefully. So let us ask the essential question. What specifically has changed, and why does the number $47 trillion keep appearing in serious financial conversations about this moment? Let us talk about debt, not in an alarmist way, but in a clear, factual way, because the numbers themselves carry the full weight of the argument. As of the most recent reliable assessments available, the United States federal debt has crossed a threshold that many economists spent decades treating as a theoretical worst case. We are now operating in an environment where the cumulative obligations of the federal government, including outstanding treasuries, unfunded liabilities, and committed entitlement expenditures, represent a structural burden that will not be resolved through normal fiscal management. The $47 trillion figure that appears in serious financial analysis refers not just to one specific line item, but to the broader category of sovereign and quasi-sovereign debt obligations across the major Western economies, combined with the derivative exposure and financial system leverage that sits behind it. Different analysts measure this differently. Some focus on U.S. federal debt alone. Others incorporate European sovereign obligations, Japanese government debt, which has reached extraordinary levels relative to its GDP, and the implicit guarantees that central banks have extended across multiple financial crises. But however you measure it, the direction is unambiguous. The debt is growing faster than the economies that are supposed to service it. Now here is why this matters for silver and for hard assets more broadly. When debt expands beyond the sustainable capacity of an economy to service it, governments and central banks face a narrow set of choices. They can raise taxes significantly, which is politically difficult and economically contractionary. They can cut spending dramatically, which is also politically constrained and growth suppressing. Or they can inflate their way through the problem, allowing the real value of that debt to be gradually eroded by a currency that purchases less and less over time. History is not ambiguous about which path governments tend to choose. Not because policymakers are incompetent or malicious, but because the incentive structures of democratic governance and the short-term pressures of electoral cycles make gradual inflation the path of least political resistance. And when the purchasing power of paper currency is under structural downward pressure, when the long-term trajectory of money's real value is declining, assets that are finite, physical, and outside the banking system tend to attract serious interest from serious investors. Gold has historically been the primary beneficiary of this dynamic, but silver, with its lower price point, its industrial demand layer, and its historic underperformance relative to gold over recent decades, occupies a particularly interesting position in this environment. The gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has historically oscillated between roughly 15 and 80 over long periods. When that ratio extends to extreme levels, it has historically corrected, sometimes sharply. For context, that ratio has recently been trading at levels that historically suggest silver is deeply undervalued relative to gold on a long-term basis. That is not a price prediction. It is an observation about a historical pattern. And patterns, understood correctly, are among the most important tools a thoughtful investor has. Let me address something directly, because I think it is the most important obstacle between most investors and a clear understanding of this situation. Most people misunderstand silver and hard assets generally because they evaluate them using the wrong framework. We have been trained, quite reasonably, to think about investments in terms of earnings growth, revenue, dividends, and market share. These are the right tools for evaluating a business. They are genuinely useful when you are thinking about equities, but they are the wrong tools for thinking about monetary metals. Silver does not have earnings per share. It does not pay a quarterly dividend. It does not have a management team executing a 5-year strategic plan. And when investors apply the equity valuation framework to a commodity that functions partly as money, they consistently misunderstand what they are looking at. Silver is not primarily a growth asset. It is a preservation asset. It is a hedge. It is a form of savings that exists outside of counterparty risk, meaning its value does not depend on anyone else's promise to pay you. When you hold a treasury bond, you are dependent on the government's promise. When you hold a bank deposit, you are dependent on the bank's solvency and the deposit insurance system. When you hold a share of stock, you are dependent on the company's ongoing performance. When you hold physical silver, you hold something that has maintained purchasing power across thousands of years of human civilization, not because of anyone's promise, because of its inherent properties, its scarcity, its utility, and the deep human consensus about its value that predates modern financial systems by millennia. Now, does that mean silver always goes up in the short term? Absolutely not. Silver is among the most volatile of the major investable assets. It can fall 30% in a year. It has done so before, and it will do so again. Anyone who holds silver expecting smooth, linear appreciation is misunderstanding the asset. But here is the critical distinction. Volatility and risk are not the same thing. For a long-term disciplined investor with a clear understanding of why they hold the asset, short-term price volatility is noise. It is psychologically uncomfortable noise sometimes, but it does not change the underlying structural rationale for holding the position. The second great misunderstanding involves timing. Many investors watch silver rise significantly during a particular period, decide they have missed the move and disengage. Then they watch it fall, feel validated in their decision to stay away, and disengage further. This pattern repeats through cycles, and at the end of each cycle, the long-term holder who understood the underlying thesis and who held through the volatility has typically been rewarded. Conviction is not stubbornness. It is the application of a thesis that has been carefully constructed and regularly reviewed. The investor who holds silver because they understand the debt dynamic, the currency pressure, and the industrial demand story is in a fundamentally different position than the investor who holds silver because a social media personality told them it was about to explode. That difference matters enormously. Let us take a step back and look at history, because while history does not repeat exactly, it does rhyme with remarkable consistency, and the rhymes are worth hearing. There have been several periods in modern financial history where the structural conditions were broadly similar to today. Elevated debt levels, currency under pressure, real interest rates negative or marginally positive, and growing institutional awareness that paper assets were not providing adequate protection against monetary erosion. The 1970s represent the most commonly cited parallel. In that decade, the United States transitioned away from the Bretton Woods gold standard, the dollar came under severe pressure, inflation rose sharply, and the real returns on bonds and equities were deeply negative for extended periods. Both gold and silver performed extraordinarily well during that period, not in a straight line, but in a volatile, interrupted climb that rewarded patient holders and punished those who traded reactively. The 2000s provide a more recent reference point. From roughly 2001 to 2011, silver moved from approximately $5 per ounce to nearly $50 per ounce at its peak, a tenfold increase over a decade. This occurred against the backdrop of dollar weakness, post-dot-com balance sheet repair, Federal Reserve accommodation, and growing emerging market demand for commodities. It was not a smooth ride. There were brutal corrections along the way, but the trend, understood in context of the macro environment, was coherent and comprehensible. None of this means silver is guaranteed to repeat those trajectories. Let me be absolutely clear about that. Past performance is not a guide to future results. Any honest financial commentator will tell you that. But here is what history does tell us. When the structural preconditions are present, when sovereign debt is at extreme levels, when real rates are under pressure, when currency credibility is being tested, assets with monetary characteristics have historically performed their function. They have preserved purchasing power. They have provided a form of financial ballast in portfolios that would otherwise have suffered devastating real losses. The question is not whether history provides a useful lens. It clearly does. The question is whether you are prepared to use that lens carefully, patiently, and with appropriate humility about what you do not know. We do not know precisely when markets will recognize the full weight of the structural pressures we have described. We do not know the specific catalyst that will trigger a revaluation of silver relative to paper assets. We do not know the path, the timing, the volatility, the intermediate setbacks that any such move would take. What we do know is that the preconditions that have historically preceded significant hard asset appreciation are, by almost any serious analytical measure, more fully in place today than they have been at almost any point in recent decades. That is not a call to action. It is an observation. And for thoughtful investors, observations are where strategy begins. If you are already holding silver, whether in physical form in a silver ETF, through mining equities, or some combination, let me speak directly to your situation. First, understand what you have. Silver in its physical form is not just an investment. It is a form of savings that sits outside the financial system. It does not have counterparty risk in the way that financial instruments do. If you are holding allocated, stored, or personally held physical silver, you hold something that no policy decision can instantly devalue, no bank failure can jeopardize, and no interest rate change can render technically insolvent. That is a genuinely valuable property. And in the current environment, it is more valuable than it was during periods of systemic financial stability. Second, resist the temptation to overcheck the price. This is more important than it sounds. Silver's price is quoted continuously, and its volatility means that on any given day, week, or even month, the mark-to-market value of your holding can move significantly in either direction. If you have constructed your position based on a well-reasoned long-term thesis, the daily price is largely irrelevant information. Watching it obsessively serves no analytical purpose. It serves only your anxiety. The investors who have historically done best with monetary metals are not the traders who watch tick-by-tick movements. They are the patient, disciplined holders who understood their thesis clearly enough that temporary corrections did not shake them from their position. Third, consider whether your position size is appropriate for your overall portfolio and your personal financial situation. Silver should generally be thought of as a portion of a well-diversified portfolio, a protective layer, a hedge against monetary erosion, not a concentrated bet. The appropriate allocation varies depending on your time horizon, your risk tolerance, your other assets, and your income stability. There is no universal answer, but the general principle of thoughtful, proportionate allocation applies here as it applies everywhere in serious investing. If the current environment has convinced you that your allocation was too small, the appropriate response is not urgency. It is deliberate, measured accumulation over time, a strategy that averages your cost basis and removes the psychological burden of trying to time entry perfectly. Finally, stay curious. Stay informed. The macroeconomic environment will continue to evolve, and your thesis should evolve with new information. A position held out of inertia is not the same as a position held out of conviction. Review your reasoning regularly. If the structural conditions that informed your original thinking change materially, be willing to adjust. That is not weakness. That is intellectual honesty. Now let me speak to those of you who do not currently hold silver. Perhaps you have watched from a distance. Perhaps you have considered it and decided against. Perhaps this is genuinely the first time you have encountered this perspective. I want to begin by saying something that is perhaps counterintuitive coming on a channel discussing silver. Not holding silver is a perfectly reasonable position, and you should not feel any pressure to change that simply because of what you have heard in this video. What I do want to encourage is genuine education. Before you make any decision about any asset, understand why you might want to hold it, understand the risks, and understand how it fits, or does not fit, into the specific context of your own financial life. If the arguments we have discussed today resonate with you, the debt burden argument, the currency preservation argument, the industrial demand story, then the appropriate response is not to immediately convert a large portion of your savings into silver. The appropriate response is to keep learning, to read widely, to consult with a qualified financial professional if needed, and to make a considered, proportionate decision if you eventually determine it fits your situation. If you do decide to begin accumulating, the evidence strongly favors a patient, systematic approach. What investment professionals sometimes call dollar cost averaging, committing a fixed amount on a regular schedule regardless of price, is particularly well suited to volatile assets like silver. It removes the psychological pressure of timing, it smooths your cost basis over time, and it enforces discipline against the emotional impulse to buy heavily at highs and fearfully at lows. The one thing I would caution against most firmly is making any financial decision based purely on the current news cycle or based on the sense that you're somehow running out of time. Markets that have structural tailwinds behind them do not typically resolve in a matter of weeks. The forces we have described today, the debt dynamics, the currency pressures, the industrial demand story, are not short-term phenomena. They are multi-generational structural shifts. If the thesis is correct, there will be time to participate thoughtfully. If you rush, if you over-leverage, if you chase the price at a moment of excitement, you are far more likely to make a decision you regret. Patience is not passivity. It is one of the most powerful tools available to the retail investor. I want to spend a few minutes on something that most financial channels skip over because it is not exciting or dramatic. But in my experience, it matters more than almost anything else, knowing what not to do. The first and most damaging mistake is making financial decisions emotionally. When silver rises sharply, as it periodically does, there's a flood of excitement, speculation, and breathless commentary about price targets and imminent explosions in value. That emotional atmosphere is precisely when discipline matters most, and precisely when it is most difficult to maintain. Prices that rise sharply from excitement rather than from fundamental shift tend to correct. Investors who bought into the excitement and not into the thesis are the ones who sell in panic during those corrections, locking in losses and learning the wrong lessons. The inverse is equally dangerous. When silver falls, and it will fall, as it always has during its broader cycles, the emotional atmosphere shifts to fear and dismissal. Commentary about silver being a failed investment, a trap, a manipulated market, floods back into public discourse. And investors who did not understand their thesis clearly enough to ride through that volatility exit positions at exactly the wrong time. Emotional investing, in either direction, is the primary mechanism by which retail investors consistently underperform the assets they hold. The second major mistake is over-leveraging. There are financial products that allow investors to gain magnified exposure to silver prices, leveraged ETFs, futures contracts, options, and various structured products. For the vast majority of retail investors, these instruments are inappropriate for long-term thesis-based positioning. Leverage amplifies both gains and losses, and it introduces time pressure that is fundamentally incompatible with the patient, long-cycle investing that hard assets require. Leverage is a tool for traders with sophisticated risk management systems. It is not a tool for the thoughtful, long-term investor described in this conversation. The third mistake is portfolio concentration. No single asset, regardless of how compelling the thesis, should represent an irresponsible portion of your financial life. Investors who put a majority of their savings into any one position, including silver, are taking on risks that go well beyond the fundamental argument for the asset. Diversification is not a confession of low conviction. It is a recognition that we operate in a world of uncertainty, and that protecting against scenarios we have not fully anticipated is part of responsible financial stewardship. The fourth mistake is blindly following online communities or social media influencers. There are online spaces dedicated to silver enthusiasm that have, at various times, made extraordinary claims about imminent price explosions, market cornering, and institutionalized suppression. Some of these claims have elements of truth, most are exaggerated, and the emotional tenor of those communities, the groupthink, the certainty, the dismissal of contrary evidence, is precisely the opposite of the analytical environment in which good investment decisions are made. Use community resources for education and information, but protect your own reasoning from the distorting influence of crowd psychology. The fifth mistake is ignoring your own financial foundation. Silver, or any investment thesis, is not a substitute for emergency savings, appropriate insurance, manageable debt, and the foundational elements of personal financial security. If you're considering adding silver to your financial picture, please ensure first that your basic financial architecture is sound. Speculative investment from a position of financial fragility is a path toward hardship, not security. We have covered a great deal of ground today, and I want to leave you with something worth holding on to. The $47 trillion structural reality we discussed is not going away. The debt dynamics, the currency pressures, the industrial demand underpinning silver's future, these are slow-moving, powerful forces that operate on timescales measured in years and decades, not weeks. They do not demand urgency from you. They demand clarity. The most valuable thing you can do with the information in this video is not to run out and act on it immediately. It is to think carefully, educate yourself more deeply, and ask whether the thesis makes sense given your own specific financial situation and goals. If you already hold silver, understand what you hold and why. If you do not, consider whether the structural argument resonates with your own assessment of the world. And in either case, commit to the kind of patient, disciplined, unemotional approach that has always, in every era, across every market cycle, distinguished investors who build lasting financial resilience from those who chase noise. Understanding cycles matters more than reacting to them. Preparation matters more than prediction. And calm, clear thinking in moments of uncertainty is perhaps the most valuable financial skill that any of us can develop. Thank you for spending this time with me today. If this conversation gave you something meaningful to think about, I hope you will share it with someone who might benefit from the same perspective. And if you are not yet subscribed to this channel, please consider doing so, not because of any algorithm or metric, but because this is a community built on the genuine belief that financial education, delivered honestly and without sensationalism, is one of the most important forms of empowerment available to ordinary people in an uncertain world. We will keep doing this work. We will keep following the evidence, reasoning carefully, and reporting clearly through every cycle, every correction, and every moment of noise that the markets produce. Until next time, stay disciplined, stay curious, and stay grounded.